Victoria, great to have you with us. I want to start off with technology because that's what you think about when you think about adding risk. And what's happened in the past month or so is really interesting for tech. I mean, we saw rates go from a recent peak of 4.2 down to 3.4. Tech stocks didn't do much, did not help them too much. Then we saw 3.4 to 3.8 to 8, where we are this morning, and tech stocks continue to fall. We also saw the dollar decline, which should have helped tech stocks. That did not help tech stocks. So what do we need here? Is there something wrong with technology here in terms of the investment picture?
It's just the wrong time to own them. Sometimes there's a right time to own them and you got paid for the risk. And right now it's risk off sale. So you're not getting rewarded for owning a longer duration technology stock at a higher multiple, because sometimes they got priced to perfection. If you look at where they were trading at the end of 21, coming into 22 at the peaks, they couldn't afford to miss at all. And now you're starting to see them struggle. You know, first you saw Facebook or Meta fall off. And then you've seen, and finally the death of the king and Apple hitting new 52-week lows. It's just too early. There are too many headwinds. You know, Apple has uncertainty about what's coming out of its Chinese factories, what the demand looks like. Google has its ad revenue problems, AWS with Amazon. You just have these shining stars that are just faded a little bit. A little too early to add in risk, in our opinion, especially when you're seeing a tightening in liquidity. You could actually track that it's more that as the Fed's run off the balance sheet, so has technology fallen. And it's just this dispersion in the market. So you have the Dow and the Russell 1000 value down about 10% on the year, and the NASDAQ and the Russell 1000 growth down about 30 to 35% on the year. And that dispersion is just what's happening in the markets right now. You need to be value, you need defense, you need cash flow, and you need reasonable multiples. Even though they've come back down and down to earth, you're still trading at pretty high multiples versus history.
Apple, though, Apple's trading at a market multiple pretty much. Do you see more downside simply because it's going to be swept lower? I mean, the thing about Apple is that it is so widely held. It is held across ETFs. And if you're going to sell technology at large, you're going to end up selling Apple. That's just the nature of it, of the market mechanics at this point.
Sure. S&P 500, QQQ, you look at any of the major technology ETFs, and Apple's a 5 to 12% holding in them. So yeah, if you're buying anything in the technology sector, you're buying Apple. And we look at Apple and say it's hitting a new 52-week low. It broke through some supports. It's struggling a little bit, not necessarily on the demand side as much as the supply side, as well as uncertain demand. I do think that Apple is a fantastic company and they continue to innovate. I think they're pushing to health with the watch and the focus on the watch. If they ever figure out how to get blood pressure or blood sugar, which is like the two things to crack, if they ever figure that out in wearables, everybody's going to own an Apple Watch. So I don't think necessarily it's a bad company. It's just the wrong time to own companies like that. And for this year and next year, especially the first half, I think it really matters where you're positioned in this market. There are tons of good companies that are just underperforming right now, unloved, and face an upward climb with interest rates rising, liquidity falling, just not the right type of stock to own right now, even if it's a well-run company.